welcome to episode 63 of Money Never Sleeps, a podcast that looks inside the head of entrepreneurs and at what makes them do what they do. I'm Pete Townsend, your co-host of Money Never Sleeps, along with Owen Fitzgerald. This episode of Money Never Sleeps is kindly sponsored by Ireland's fintech and financial services recruitment specialists, Top Tier Recruitment. If you or a colleague need help attracting or retaining great talent for your fintech or financial services company, it is highly advisable that you build a relationship with a team at Top Tier Recruitment. You can find them at toptierrecruitment.com and tell them we sent you. In this episode, we captured a fireside chat that I had with Zishan Feroz, CEO of Coinbase in Europe, at the Blockchain for Finance EU 2019 conference in Dublin earlier this month. Z and I covered Coinbase's institutional presence, custody as a building block of the crypto economy, and the view on regulation in crypto. This one was a heck of a lot of fun, so let's just jump right in with episode 63 of Money Never Sleeps.
Money never sleeps, pal.
Good morning again to everybody. Z, welcome. I know that you spent a lot of time in Dublin, but it's good to have you here again.
It's good to be here.
Awesome, thanks. So what we're going to do, folks, we're going to talk about Coinbase's institutional offering in crypto and what they do there, just to kind of kick things off, but then look at some trends in institutional crypto, and with a shout out to Noel Atchison, who has a column by the same name in CoinDesk, sitting right there in front of us in a lovely red jumper. We're going to look into custody as well, and how that is kind of a building block of the crypto economy. And then if we have time, take a little look at regulation. So Z, just to kind of kick things off, can you tell us about the institutional offering that Coinbase have and how that's developed over the last couple of years?
Sure. I think historically we've actually been a retail business. So Coinbase, for most of its life, we're a single product company. We had a wallet that we offered to retail customers. That was the easiest, simplest, and we tried to be the most trusted way of acquiring crypto. But over the last 3 odd years, we have significantly expanded what we do, particularly into the institutional space, and much of it has been driven by the trends we've seen in the industry and the demand we've had. Today, Coinbase's institutional offering, for example, it includes an exchange. So we operate our own exchange. We have been investing significantly in our custody operations. We are now one of the largest crypto custodian out there. We operate an OTC desk, and we continue to invest in our institutional products and the teams. We've got a coverage team. So it's been one of our highest growth verticals over the last few years, and it continues to be a significant focus for the business. The retail side continues and actually partners very well with the institutional piece for us, so that continues to be bread and butter, but we're really seeing a lot of growth in the institutional space.
Okay, and what are some of the specific products that have been working well for you over the past year or so?
So I think So we've done a bunch of things for us in terms of growing the product. So if you think about our exchange, for example, we used to support, I think there was 3 assets 3 years ago. We now have added on about 20 assets, and I appreciate that's less than what some of the other exchanges do, but we have 40-odd regulators in the US. We need to get sign-offs from regulators over here across the world. We need to get everybody on board before we list one asset. So it's a slower process for us. So adding additional assets has certainly been something that we've focused on, and it's driven growth. We have, with the custody operation, that's something that we found increasingly being requested by institutional clients. We believe it to be quite a foundational building block for things like derivatives. So we have continued to invest in that infrastructure, built a team around it. We went out and acquired a trust charter in the state of New York, which effectively makes us a bank to be able to offer regulated custody offerings in the US. And then we've also got an OTC desk that we've expanded over time to provide some of the larger client needs in terms of trades.
Okay. And just so everybody knows when we're talking about it, who in the crowd has a cryptocurrency wallet on their phone, by a show of hands? All right, good. Good exposure there. When we're talking about, for those that don't, when we're talking about cryptocurrency and talking about Bitcoin, ETH, Litecoin, Ripple, those are kind of the mainstream cryptocurrencies, and beyond that you have altcoins and stablecoins and others. Coinbase generally depending upon the day that you're looking at the overall cryptocurrency market, some people will quote 2,000 cryptocurrencies out there. Some people will quote 6,000. Okay, out of that, as Z said, there's about 20 that Coinbase have listed on their exchange and available within the wallet. So that's it's a small part of the overall microcosm. Do you see that as a good thing, or as something to grab more hold of as you progress?
I'd love to say so. There are some coins that we just won't list because they're obvious scams.
Yeah.
But I think what we tend to do is we take a very diligenced approach to how we list assets, and given the lack of regulation in this space in terms of what could potentially be a security, what's not a security, for example, is a challenge. And we want to build a long-term sustainable business, and what that requires us to do is to work with our regulators, the governments, to ensuring that we are always operating on the right side of the hypothetical line as it exists today, or doesn't exist today. Yeah. So I think 20 is just it's a result of a thought-out approach in terms of working with governments and what we think we can list. What we are trying to do, though, is what we don't want to be is kingmaker, when it comes to cryptocurrency. So what we want to do is let the market decide in terms of what they want to invest in or trade in or interact with. So we're taking steps to be able to support more currencies. Last week in the US, we announced the Crypto Ratings Council, for example. That is an initiative we've put together with a bunch of other crypto businesses to try and start to jointly assess and make recommendations for crypto assets, whether they are securities or not. And we're hoping this is the kind of thing that emerges from the industry and is adopted by the regulators and governments to create a framework for what assets fall under security, what can be listed as a utility token, and therefore opens the gates for us and other exchanges to start listing more assets.
Absolutely, and I think we're seeing a bit of that going on around the world, which is kind of the crypto economy trying to beat regulators to the punch, right? And saying, let's go out and set some standards, get things agreed between us, and then put these forward to the regulators when they're doing their consultation papers. And there's a lot to contribute there. We're going to take a look at regulation in a few minutes, but just looking at some of the trends and talking about the crypto economy, how do you see financial institutions engaging with the crypto economy in recent history?
I think there's been an extraordinary amount of interest in the space over the last sort of year and a half. The way I describe it is, I think we had the hype cycle in 2017, and a lot of institutions engaged in that period. But I don't think the industry was ready to have the infrastructure to facilitate mass adoption the way it came knocking. Yeah. So we struggled with things like capacity on networks, etc. And I think where we are today is effectively what I'd call a build phase, where a lot of businesses are heads down building the necessary blocks for what will ultimately be institutional adoption. Mm-hmm. And to me that's incredibly exciting because it's we're not putting the cart before the horse, which to some extent felt like happened in 2017.
Yeah, it's kind of like in 2001, 2002, after the dot-com bubble, where the Ciscos and Amazons of the world started building all this infrastructure for what would then become e-commerce.
Absolutely. And, you look at, I think it was last week that Morningstar announced that they're looking at crypto assets for issuing ratings. Yep. You've got Fidelity Digital Assets that's doubling down on their institutional offerings. So I think there's a whole bunch of good building work being done in this space that's laying the foundation for institutions to ultimately come in.
A few of the things I'm working on, Z, it feels like you can have the conversations with financial institution executives and you can see the look in the eyes of the ones that realize that the backbone of the financial markets is changing and that it is becoming digital. Do you have those types of conversations as well with executives in financial institutions?
We have, and it's a real range. Some people absolutely rejected as, oh, it's a fad, it will pass, and so that it's a range of conversations where some are enthusiasts, where others are skeptics, and I think that's it's good. I think the skeptics keep us honest and ask the right questions, and we try and answer those. Whereas it's encouraging seeing the enthusiasts within the ranks of traditional financial institutions.
Absolutely. Do you think there's a concept there of trying to build that bridge, right, between the call it the fiat economy and the crypto economy? What are some of the types of things that you can do that are, kind of inserting into that space that are helping to build that bridge, right, around how people spend money, and how people actually invest money, and how that money is then invested on their behalf? Is there a link there that you guys are working on that's interesting?
I think that kind of is reflected in the range of services we offer, right? So we don't necessarily see crypto as an investment instrument that we're building for institutions. So on this side of the spectrum, effectively on the retail side, we have our Coinbase wallets. And what we're trying to do is we're trying to encourage people to see the utility in these. So, for example, we launched the Coinbase card earlier in the year, which is a debit card tied to a crypto balance. And people are excited about walking into shops and buying stuff with crypto. We've had some really interesting tweets about it in terms of how they're spending their crypto balances. So on the one hand, we're trying to build products that fit into your pocket, that help take it mainstream as a utility, and whether that be as a form of money. We've also got the Coinbase Wallet app, which is allowing people to interact with decentralized apps. So it allows you to use your tokens. And then we've got things like Coinbase Commerce, which is effectively, for those that know, it's like a Stripe. It's a payment gateway that allows you to make payments in crypto. So what we're trying to do is there is the community that wants to use this as most folks see it as an investment, but really the underlying value is in the tech and its ability to revolutionize the financial system, as you say. So. But I don't, with retail customers, I don't make a lot of people pitch it as, oh, it's crypto, it's cool. And I think retail customers don't care about that.
No.
What they care about is, what do I get from this? And that's when you start to think about, like, well, you can send money in other places for, a lot less cost and a lot quicker. So it's about improving the user's experiences with routines and tasks that need to do on a daily basis. And that's what crypto is helping with, and that's what we're trying to bridge to it.
I gotcha. What I'm seeing as well in the market, Z, is, for example, with my mom and dad looking at what I do, and they say, Pete, should we buy into crypto? And I said, well, listen, that is your own decision. I'm not here to give financial advice, mom and dad. But where I see it working in the investment space is where, in the same way that Chicago commodity traders trade pork bellies, right? Where someone has figured out an algorithmic piece of trading software, right, that says I'm going to be able to arbitrage across exchanges and be able to turn a day-to-day profit or hour-to-hour or minute-to-minute profit out of trading mainstream cryptocurrencies. And they do that in an institutional setting within a crypto hedge fund. That crypto hedge fund, in order to stand up to institutional investors and even high net worth individuals that are doing due diligence on how they run things, they need to have a custodian, right? How do you see that need for a custodian kind of pushing things forward on the institutional side?
It's just a foundational need. So if you think about this, for example, again, an example from last week, I believe, is the Hong Kong regulation that came out for crypto assets, and they'll be licensing exchanges. They're effectively treating crypto assets, most of them, as securities. But one of the requirements as part of that regulation is to have a third-party custodian. So I think that is quite a fundamental part of our current infrastructure, and being able to go out and find regulated custodians that you trust, I think, is again one of the building blocks for what I see ultimately will be the institutional money flowing in. So being able to go find custodians that can clear, that have the right insurance, that have the right crypto infrastructure. And it's interesting so we have a crypto custody product, and I tend to talk to some of the largest banks out there. Like, I went in to discuss custody with a bank that had, I think, something like 15 trillion or something in custody.
Yeah.
And it's a really interesting conversation because they're comparing their current infrastructure with what our crypto custody infrastructure looks like. And there's conversations around hot and cold wallets and how clients want access to it. So I think there's a really lively conversation about very quickly maturing our custody, the crypto custody offerings that are out there to be at par with what traditional custodians do to ultimately help have that building block for the institutions to invest in it.
Yep, I get you. I'm obviously proud to be on the board of Coinbase, and when I'm out talking to people and doing meetings and asking them if they know about certain things going on out there in the economy, and I show them the Coinbase wallet on my phone, right? I give them the view of, okay, you can see, now I've got very little in mine, right? So I'm not like giving anything away. I didn't get in until 13th of October 2016, I think, was the date of my entry point to the crypto world. But anyway, long story short, what I show them is to say, here's BTC, here's ETH, here's Litecoin, here's a number of other cryptocurrencies you can hold. Imagine if you take out LTC or you take out XRP and you replace that with MSFT or AMZN, right? Or you have publicly traded equities that can be held in custody, those digital formats of those publicly traded equities. Do you see the market going in that direction? Absolutely.
I think it's just, the benefit of that is, one, it's a great accounting method for tracking those stocks and, for securities, assets. I think it also opens up, it creates transparency in a way that doesn't exist today. It creates the potential for 24/7 markets. It creates the potential for interoperability between pairs where you can trade an AMZN for a bar of gold, for example. So I'm actually very excited about, and we were the gentleman before us talked about the killer app, and I think tokenization of securities is one of those which will be forthcoming.
Yeah, absolutely. Okay, looking at regulation, Z, I got a lot of clarity, which I think was the intended point of the FCA releasing their guidance paper in July on crypto assets specifically, and the definitions around that. I think they did a great job in saying out to community with their initial consultation paper earlier in the year to say, here are some definitions. What do people think? And they got a lot of feedback, and then they updated that, and they came forward with something that I think is quite useful in saying to people, if you're doing anything generally in the crypto space, or as if you were running those activities in the fiat world, and they would be regulated, kind of aspire to the regulation in the fiat space, right? And we see a number of different companies that are doing that, seeking regulation, and Coinbase was one of the first ones to do that. How do you see regulation being of benefit to the overall crypto economy going forward?
So we took that approach. We looked at where we think the regulation is in comparable markets, and we went out and acquired those licenses wherever we could. I think. So I probably have a less than popular view within the crypto liberals in that sense, but I think regulation is an incredibly good thing. I've engaged ever since I've been at Coinbase. I've engaged with the ECBA, the ESMA, the FCAs of the world. We with FATF at their forum in Vienna earlier in July, with IOSCO in terms of what the securities regulators are thinking about. I think having a uniform regulatory framework will do wonders for this space because it creates a basic hygiene level that will allow you to know who you can trust, at least from a basic standards point of view. We regulation of financial institutions is about keeping your money safe today and protecting consumers, broadly speaking. And I think, we, Coinbase as a crypto business, we hold billions, tens of billions in customers' assets. But to think that a lot of these businesses are unregulated, there's no accountability. They disappear overnight, some of them, So that's worrying. And I think having that regulation to be able to say that there's a regulator that has oversight, that has audited and has authorized you as a business will do wonders for the space. And we try and work with the FCA and we've engaged with the CBI and other regulators to try and help them understand the space. And sometimes it's just that. It's us sharing our knowledge. And other times it's providing input into consultations. It's providing input into workshops that they have around how to regulate this space.
Yeah, no, I think it's important. I like to see it growing and developing. I think there is, looking around the world and seeing the different regulators speak up and start to make some moves around this and publish some documents. There's, what's going on in the U.S., what's going on in Europe. There's a bit of differences there in how things are being defined. Hong Kong, as you mentioned, is there a global approach here that can eventually unfold?
Is there a global approach in traditional financial services?
Absolutely not. Absolutely not. And I think that's one of the big things, right?
Yeah.
Is that, I like to talk about global formation of capital, right? And that you're able to actually, regardless of whether you have an investor in Hong Kong or you have an investor in Alaska, that you're able to contribute and buy into a ski resort in Aspen, Colorado, right? And have that be fully digital through Aspen Coin, which was an interesting development a couple of years ago, right? And you can see that moving. I see kind of the central banks, the regulators, as trying to prevent two things, trying to protect two things, really. Investors, investor protection, and then systemic risk, right? And I think if you can, with your own business, with your own governance, if you can nail those two things, now are you never going to nail systemic risk, right? Because that is system-wide. But investor protection is, you can do a lot and go a long way to looking out for customers and individuals.
Yeah, and I jest, but really, I think something that is more global will mirror crypto's nature, where it's not sovereign and it can transcend boundaries in a way traditional financial system doesn't.
Yeah.
So I think there is a need for it. I see folks like FATF taking initiatives and trying to harmonize. I also see, again, I mentioned IOSCO. These. What's funny is, 3 years ago, you'd approach regulators and have a conversation, and there wasn't a lot of interest. It was too small. It wasn't something that they had time for at the time. And I absolutely love engaging on these forums now because there's real interest. I sometimes walk into these meetings where, so the IOSCO meeting was about 50 regulators, for example, in a room, and crypto exchange, and it is quite it's a great place to be, a forum to be able to say, look, here to answer all the questions. Our intentions, our goals are aligned. We want to create a safe environment that facilitates innovation and allows this industry to foster. So it's increasingly, it's very encouraging to be at these forums, engaging with regulators and driving global regulation. Whether it truly happens, whether we get a global regulatory framework here, I don't think so, particularly as jurisdictions try and position themselves as crypto-friendly. I think some will, lead, whereas others may not. But I think we're having engagement at the right level.
Good. And just, again, building that bridge between crypto and institutions a bit more, a lot of the conversations that have been going on in the last 5 years have been around, maybe not crypto, but I love blockchain, right? And where that's gone. And when we talk about blockchain, talking more about not the Bitcoin blockchain and everything that goes along with that, but distributed ledger technology, and kind of the blockchain for institutions, right? And in that conversation, people talk about public blockchains versus private blockchains or DLTs. Where do you see things unfolding with that, with the benefits of either side, whether public blockchains or private blockchains?
I think they both have a place. I think public blockchains promote transparency in a way that is authentic, and you don't need to trust a third party. You can operate in a trustless environment. So, and we've demonstrated that with some of the blockchains that exist today in terms of, say, crypto transactions, for example. But I also think that not everyone wants all of their dealings to be public. Yeah. Salary payments to a doctor, for example. So I think then having private blockchains is certainly something that has a place in the world, and therefore we've seen development, on a lot of private chain projects. And they'll continue to grow. I think ultimately where you'll end up will be these two models will coexist, and there'll be use cases, and perhaps there'll be choices that businesses make where some use a public blockchain as perhaps a bit of a sales pitch to say, look, everything we do is transparent. But I think, particularly when things like, let's say, charities, where transparency is incredibly important, to have a public ledger of how those funds are distributed is incredibly valuable. Whereas a bank would perhaps not want that level of transparency. So I think there's horses for courses.
Absolutely. And you get things like you hear about, land registries and what that can do to actually, reconnect people back to their family heritage, right? We've owned these lands for centuries. Where are the boundary lines? Can those be drawn? Can those be officially mapped into a single proof of, yes, we own this, right? That's something that, in kind of the blockchain for good mantra that, I think can be an interesting development as we move ahead.
Oh, God, I have a personal thing for that.
Yeah.
I went through a flat purchase in London a few years ago, and the number of people that were involved in that, and it was a leasehold, and I'd love a public registry of property, yeah.
I know, that'd be a good thing. Any other questions from the crowd? Noel? Oh, we'll start in the back. Sorry, we'll come back to you. Noel?
Hi, good morning. I have a question about the topic of regulation. I have been in the crypto industry, on the blockchain industry, and before in capital markets. My question comes from the perspective of what is the crypto world thinking of doing to avoid regulations, to have the same pitfalls that we have seen in capital markets that didn't stop things like the London whale happening. Sorry for the JP Morgan folks here. But we have seen that although a regulation is good, it doesn't stop bad actors. Are cryptocurrencies and the crypto industry thinking of ways to be better?
There's going to be bad actors in everything. I think, in all honesty, I think this is a cat and mouse thing in terms of us identifying gaps and then trying to plug them as best as we can. I think the way to look at it is crypto assets and public blockchains, they offer certain additional tools to be able to create controls around perhaps, rogue traders, for example. But this isn't there's no magic in the chain itself that will prevent it. It's a tool that we can use to create rules that help prevent that. And I think that it's the application of it and the empowerment it gives to the institutions, which is what's valuable. Whether they choose to use it or not will ultimately be a decision that those institutions make.
Thank you.
Noel, I think the mic's coming forward for you here.
Hi, thanks. That was very interesting. Coinbase does have a very strong institutional-grade custody offering, and several sources have confirmed that of the hedge funds that are active in the space, you do have easily the largest market share, and this is not a plant, I promise. Here comes the question. In terms of institutional involvement, the sector is still very young. When the big institutions come in, and the BlackRocks, the Vanguards, the pension funds, insurance funds, do you see Coinbase trying to go after that kind of client, or will Coinbase entertain the idea of collaborating or cooperating or joining forces with the traditional custodians that these large funds are used to using and will probably want to continue working with? Are you going to be competition to each other when the incumbent custodians take a look at this space, or do you think that you'll end up working together?
Can we be frenemies?
Is that possible in this sector?
I think we have a distinct advantage as a crypto custodian, and that advantage is we are a crypto-first company. We wake up and all we think about is crypto. We eat, sleep, drink crypto. And what that allows us to do is really invest all of our resources and our mind share in the crypto space, in the development of our crypto custodian products. That is not something which, say, a traditional custodian does. And if anything, large organizations don't move as quickly. But the flip side to that is they look at counterparty risk. And what they may be able to say is that, picking a name, Northern Trust is has the balance sheet that the BlackRocks want and Coinbase doesn't. So I think there is room in the world for our standalone crypto custody product. We're seeing that. There's crypto-first funds that are out there. But I'm certainly not averse to engaging with existing custodians because I think our knowledge and expertise in the crypto space can help provide the infrastructure they need to build a custody product. So I genuinely mean this in the sense of, to give you a comparison, Apple used Samsung screens for the longest time, but Samsung was building its own phones as well. I think there's an element there in terms of us being the underlying provider, providing some of the technology or partnering to some extent, but also having our own product.
I think just to add to that as well, the biggest thing for the institutional custodians, they look at DLT first, right? And they say, can I save money? Can I reduce the cost of my infrastructure? Can I actually move up the curve digitally in terms of my own transformation? You can look at the ones that are digging deep into DLT and separate them into two camps very roughly, so take no commercial direction off of this. But that those that are involved with Clearmatic's finality, right? That those custodians that have signed up, the institutional custodians that have signed up to work with them, and those that are not. Those that are not are generally probably doing their own things and probably would be the first ones to plug in. Now, a solution for digital central, wholesale currency versus a cryptocurrency custody are night and day in two different things right now, obviously. That was the first point. The second point is I've talked to a number of the custodians that are looking at crypto, and what they realize after the conversation is that when you're looking at crypto custody versus traditional custody, on the traditional custody side, there are two key things, settlement and safekeeping. On the crypto custody side, settlement goes, right? Because the trade is the settlement. When you get into the safekeeping goes from a multi-ledger electronic representation of a street name asset to key management, right, as being one of the big things. Not the only thing, but one of the big things. So it's kind of night and day. And if you look at the future circle of the overall post-trade market on the institutional side, where we have names like Northern Trust, like BNY, JP Morgan, BNP Paribas, all operating in this custody circle, right, with trades and volumes of trades going back and forth to each other all the time. I think that what you'll see in the future is not just those financial institution names, but I think you'll see an Amazon in there. I think you'll see an AWS in there, because what's really important in this type of environment that we're heading towards are security, scalability, cyber prevention, those types of things that these bigger organizations on the tech side have really grown up around. And I think that's what we're headed towards. Any other questions?
Yeah, just got one question. Just with respect to settlement, I'm interested in cryptocurrencies and the sort of the adoption on a mass retail basis. And I'd just be interested in the views in respect of the settlement latency issue and how that's been dealt with. You know, it does take a while before the blockchain is actually settled and closed, before the actual before the purchase can be settled. So, for example, if I'm paying cash in a shop, it's settled there and then. But let's say I'm paying with a cryptocurrency. My understanding is there is a settlement latency, which means the shopkeeper may not necessarily get value while they pass over the good to me. Is that still an issue, or is that something that has been dealt with, or is that a problem?
So, what's interesting in that is that the belief that when you pay using your card, that it's instant settlement. because those funds usually are settled to the shopkeepers on a T+1 or a T+2 cycle. So the £10 or €10 you spend at 12 o'clock on a Monday, the retailer probably gets on a Wednesday around midnight. I used to work in payments for 10 days, and one of the things I'd negotiated with retailers was the settlement time cycle for them. To the extent that some would actually pay higher fees for quicker settlement to facilitate cash flows. I think what you're really, the real question there is the speed of authorization rather than settlement. Because if we're talking about settlement, like crypto kicks the traditional system's ass, right? But so when we're talking about the authorization, then yes, like if you look at Bitcoin, for example, then yes, there's a delay. But there are other chains that are emerging. There are layer 2 solutions that are emerging that offer near instant authorization. And I think that is part of the maturity of the system when you will get you'll get crypto chains that are transaction focused and have the throughput and finality of settlement and speed that you require in a retail transaction. You have several chains out there, without naming names, that are solely focused on that and working towards it.
Yeah, that's very interesting. So I suppose from a shopkeeper's perspective, obviously they have a sort of a credit risk while that money comes through. So it'd be very important, I would say, from a mass retail perspective, that credit risk is guaranteed by somebody with a very large balance sheet. So there is a certainty there. I think that would speed up the I suppose the assuredness, let's say, of the velocity and the certainty of the payments coming through. So that's my view.
And you touched on another very good point, because the credit risk is also one of the biggest things that everyone who's ever accepted card payments manages, because you can be charged back for any of the transactions that you pay on your card. And as a retailer, the responsibility within the chargeback scheme is on you to defend the transaction, to prove that it was the person who paid for it. And you get things like 3D Secure and chip and pin to facilitate that, but you can still raise a chargeback and be liable as a retailer for those funds. Whereas with a crypto asset, once the transaction is confirmed, it is confirmed. So again, I think you're helping make the case for crypto in terms of the credit risk. I think it is significantly better for e-commerce retail businesses that have to deal with this book. And bear in mind, the credit risk for chargebacks is 12 months. So, you could, technically you have that risk as a retailer on your books for up to 12 months. But crypto, it'll be the matter of seconds that it takes for the chain to update, and after that, the transaction cannot be reversed. There is a flip side to this coin as well, because it's about consumer protection, and consumers have a right to to ask for a refund if the goods don't deliver what they want. Which you cannot do with crypto assets. There's no reversal, but there are again solutions you can build on top of that.
Thank you.
Great. That about wraps it up, folks. So thanks so much. Z, thank you. It was great to talk to you up here on stage.
Thanks for having me.
First time. Thank you.
Money never sleeps, pal.
That does it for this week, folks. And thanks so much to Z for an awesome chat on stage at the BFC EU 2019 conference. We'd like to extend a special thanks as well to Hannah Kitchen and Dean Murphy for organizing a great 2-day event and for sharing the audio track with us. Links and show notes for this episode are on moneyneversleeps.ie, so check us out online. Remember, if you or a colleague need help attracting or retaining great talent for your fintech or financial services company, it's highly advisable that you build a relationship with the team at Top Tier Recruitment, as they really know their stuff. You can find them at toptierrecruitment.com. Also, thanks to Conan Brophy from Create Sound for editing this podcast. As for me, I increase the odds of startup success. DM me on Twitter at PTownsendNV if you want to know more. You can follow Owen on Twitter at OwenFitzgerald9. Finally, till next time, thanks for listening. See ya!